Today we're going to talk about casualty and theft losses in our itemized deductions. And so the main rule with casualty and theft is that the loss has to be sudden, unexpected, and unusual in nature. Sudden or unexpected, so basically you leave your car unlocked and somebody steals something, that doesn't count because that was a little bit careless on you. You should expect things to disappear out of your car if you leave it unlocked. Things like that. Unusual, unexpected, sudden, so usually natural disasters are going to fall into that. Even if you live in a zone where there are earthquakes, it's still going to be considered a casualty if it's an uninsured loss. So if you get reimbursed by the insurance company, it's no longer your loss. But any amount that wasn't reimbursed by that the insurance company didn't pay for, that would be considered a loss. There are some really great examples. The first one I want to read, a taxpayer has an automobile that he decides is a lemon and he wants to get rid of it. He drives his automobile to the top of a cliff and pushes it off. Well, that was willful. That was not sudden or unexpected. You can expect your car to crash if you push it off a cliff. So he didn't get a deduction for that one. The next one, though, under Would You Believe, I really like this one. A taxpayer left his car in a tow-away zone near his apartment building while he was on vacation for 2 weeks, and when he came back he discovered that his car had not only been towed, but they had crushed it. The IRS disallowed his casualty loss because it claimed that the taxpayer could have prevented the loss by not parking in a tow-away zone. Fortunately, he went to tax court, and the tax court overturned the IRS's determination, saying that he couldn't have known that the city was going to destroy his car. He knew it was going to be towed. He was expecting to pay the fee, get it back. He didn't know it was going to be towed in such a short period of time. So they should have allowed that one. There are lots of other ones. There are lots of rules about measuring the loss. I'm not going to ask you any questions like that. If you end up with a question like that on the test, I will throw that thing out because I don't want anything like that. There's a 10% floor. There's all kinds of goofy stuff. So or a $100 floor, I'm sorry. We're not going to talk about that. One thing I do want you to know, and this is really important because this is taking place starting in... Actually, I think it starts next year, but it has to do, basically, personal casualty and theft losses are no longer going to be associated, they are no longer going to be deductible unless they're associated with a federal disaster area. So when the president declares a federal disaster area, that's the only time that people would be able to take this loss. That's pretty wild. So the rule in the past has been if the president declared a federal disaster area, then you could take that loss in a previous year. So let's say it happened this month in May. We had some tornadoes go through. You experienced a loss. You could do an amended return for 2017, get a refund for any amount of loss. To give you a little bit of relief right now rather than having to wait until the tax year ends and then it'd be almost a year at that point before you ever got the money. So they will allow that, but again, moving forward, these are no longer going to be deductible unless they're associated with a federal disaster area. It takes an awful lot for that to happen. So I have a feeling that we're not going to see a whole lot of this anymore. I'm not even really going to spend a whole lot of time on it. It's not going to show up on our sample problems or anything. So that's it for this one.